Why did Bitcoin fall 10%? That's the question that's on everybody's mind. It's swiftly rebounded off of its 200-day moving average, but the question remains, what just happened? What were the reasons behind it? And where are we going? In today's Bitcoin update, I'm going to be taking you through all of what's going on, from Mt. Gox bankruptcy to Bitcoin ETF net outflows that have happened since June 10th. We're going to take a look at some price study. Bitcoin fell beneath the 80-day and 200-day moving average. We're going to take a look at short-term holders and see what they're doing, and then ultimately conclude with why we believe that this is just a healthy correction that needed to happen after a 170% run-up in Bitcoin's price since last October when all of this huge bull market bonanza began. So sit back, relax, and grab a drink or something, and we'll get right into it. Today's going to be a long one. Got a lot of charts for you, so please enjoy. But before we do, a word from our sponsor, River. River is our Bitcoin exchange of choice. You can invest in Bitcoin with confidence at river.com. Well, why are they the Bitcoin exchange of choice for the Bitcoin layer? Well, put simply, they have multi-sig cold storage, one-to-one self-custody for all the Bitcoin that you keep with them. They're fully licensed and regulated all across the U.S., and they have U.S.-based phone support. Guys, River is a Bitcoin exchange that you can trust. They're a longtime partner for that very reason. So if you want to finally start taking your Bitcoin stacking goals seriously, go to river.com, and you can use the link river.com/TBL to claim $100 in Bitcoin when you sign up and buy some Bitcoin. Again, that's river.com/TBL to claim that code. So without further ado, let's dive straight into it. So Alex Thorn, the head of research at Galaxy at Intangible Coins on X, made a very good thread that got a huge amount of traction yesterday that I want to walk you through it. It's basically about the Mt. Gox repayment, the early repayment that is slated to begin in July. At the end of the day, with Mt. Gox, when we receive news of the repayment, the price always falls. Right around that time, the price always falls. But Alex believes that most creditors are unlikely to sell. So I'm going to take you through what he said in his thread. So creditors have been stuck in the Mt. Gox bankruptcy for 10 plus years, since 2013. An in-kind distribution of Bitcoin and Bitcoin Cash, the fork-off of Bitcoin, is set to begin in July. Now, Alex thinks that fewer coins will be distributed than the market thinks, and it will cause less Bitcoin sell pressure than the market expects. So walking you through some of the numbers here that you can see up on screen, Mt. Gox lost 940,000 Bitcoin, and they were able to recover about 142,000 of it. Okay, so $63.9 million is the amount that these 140,000 Bitcoin were worth at the time. Now they're worth $9 billion. Okay, so in about 11 years, they were only able to recover 15% of the Bitcoin that was lost, that was stolen in the Mt. Gox hack. But that's a 140x gain for creditors in US dollar terms. Okay, so that's a pretty huge upside for creditors. Now, undoubtedly, that is a big, enticing United States dollar number. But in order to get a payout in July when they're scheduled, creditors will have to take a 10% haircut. Now, Alex and the Galaxy team estimate that 75% of Bitcoin that is being repaid chose this option. Okay, so 75% of Bitcoin chose to unlock it in July and have it repaid to them. So that leaves about 95,000 Bitcoin and Bitcoin Cash for early pay. Okay, of the 142,000 Bitcoin Cash mix, 95,000 of it will be repaid in July. It's slated to. That's what the Galaxy team is estimating. Okay, so the breakdown of that is that 20,000 Bitcoin are owed to claims funds, 10,000 Bitcoin are owed to Bitcoinica, which is an old Bitcoin speculation market, and 65K are owed to individual creditors. Now, the creditors are the big thing that we're going to be talking about. And the 65K, that's way less. Okay, because the individual creditors are largely what matter. That's way less than the 142,000 Bitcoin that's touted regularly by the media. And individual creditors may be more diamond-handed than the market expects. Alex outlines his reason for it here. You could follow along on the screen. If you're listening to this on the podcast, I'll read them off to you. Number one, creditors are significantly skewed toward long-term Bitcoiners. They are tech-savvy early adopters. And this makes sense. The people that were buying Bitcoin in the early years, they're not the fair weather Bitcoiners largely that are in the market today. They're the early adopters that were in it because of the technology, right? And so because they're tech savvy early adopters, chances are they might be more diamond handed. They might be more prone to holding their Bitcoin than the market anticipates. Okay, that's number one. Number two is that individual creditors have resisted years and years of compelling and aggressive offers from claims funds, which suggests that they want their coins back rather than a US dollar denominated payout. They've had chances through the years in order to get some kind of payout, in order for a claim fund to take that Bitcoin from them off their hands for a US dollar amount for some kind of haircut. And individual creditors have resisted years of that. So clearly they want the Bitcoin. They may not necessarily want the US dollars, okay? And number 3 is that capital gains impact of selling would be huge. It's a 140x upside, right? With the price appreciation that has happened, even though it's only a 15% in-kind recovery from the amount of Bitcoin they initially held, claims holders are up 140x since bankruptcy on their recovered coins in US dollar terms, okay? So it'd be a huge capital gains hit. So that being said, if only 10% of the 65K coins, Bitcoin and Bitcoin Cash, are sold, right, the coins that the individual creditors own, that's 6,500 Bitcoin dumped onto the market. That's a pretty large amount of Bitcoin, okay? But Alex believes that the number of coins being distributed is lower than the market expects, okay? Right? This 142,000 Bitcoin number that's been pushed by every major media outlet because it's easy to get a headline. That's a huge amount of Bitcoin. That is a percentage, a meaningful, a measurable percentage of the total outstanding Bitcoin. 6,500 compared to 142,000 is much lower than what the market has expected. And he also believes that Bitcoin Cash will perform worse on a relative basis to Bitcoin once the coins are distributed in July. People want to hold Bitcoin for the long run, particularly these tech-savvy early adopters. And so the market impact, the selling pressure, is estimated to be much lower than what the market actually believes it will be. People will likely dump the Bitcoin Cash, dump the garbage, as they do with literally every other Bitcoin fork that has occurred. They dump it, it goes to zero. Chances are the Bitcoin Cash will be liquidated, and the Bitcoin, more of the Bitcoin than people expect, will be held. Okay? And that said, there's actually proof that this is what very well may happen. We're going to get into it right now, but first things first, we're going to shift gears on our Bitcoin and global macro analysis to Bitcoin price, one of our favorite things to talk about, of course. So, as you can see here, this is every single time, or the last 3 times, that Mt. Gox repayment FUD has dropped, right? So FUD around, oh my goodness, the Mt. Gox coins, 142,000 are going to get put onto the market. The market's going to dump. Every time, the last 3 times that has happened, look at what's happened to Bitcoin's price. It has, and you can see my cursor here. Look at. So I marked the last 3 times that this occurred on March 6th, 2023, right here, November 22nd, 2023, and January 6th. What do you notice about basically every single time FUD drops? Okay, Bitcoin goes on to form a local bottom. Now, it might not happen immediately afterward, like in the case of January 6th, 2024. It took several weeks for Bitcoin to form a local bottom, just 3 weeks on there. But it goes on to form a bottom and move higher every single time. So FUD is some of the most potent Bitcoin fuel. And what are we experiencing right now? We're experiencing more FUD. And lo and behold, what do you notice? June 2023, basically when we started seeing more FUD, what do you notice? The price drops, and chances are, if history is any indication, Bitcoin is consolidating. It's forming a local bottom here. Wonderful. Very, very good news. So we're going to move on here to the ETFs. So ETF net outflows right here, those have been negative since June 10th. Okay. And this is the most persistent regime of net outflows that we have witnessed. Take a look over here. In the past, when we've experienced bouts of net outflows, we saw a pretty bad one here during late April, early May, my birthday. And then we went on to see a month of pretty persistent net inflows, a huge spike at the beginning of June, and now coinciding with the underperformance in Bitcoin's price, Bitcoin ETF flows have been net outflows. We've had a big regime of net outflows since June 10th. Well, Sam Callahan made a great thread about this, the analyst over at Swan. You should give him a follow on X at Sam Calla. He made a thread about what one of our favorite analysts, Checkmate, over at the Check On Chain newsletter at checkmatey_ on X, had to say about why this is happening. Well, the reason, one of the theories that is, pretty accurate, is that around the time that this happened right here, June 10th, was around the time that the Bitcoin cash and carry trade really deteriorated. What do I mean by that? Well, around this time, the premium collected on the cash and carry trade has declined. Now, the cash and carry trade is where you borrow short and lend long. And you can note here that the perpetual futures funding rate, so the amount of money that people can earn within the perpetual futures market has gone down from 10% annualized to 6% annualized. Now, you'll note that the 5.25% risk-free rate, that's the current federal funds rate, that's a pretty low spread between a high-risk, high-beta asset in Bitcoin and the colloquial risk-free rate. Okay, it may not be risk-free. Obviously, you have dilution risk. There's Bitcoin has a disinflationary supply schedule. But right now, Bitcoin is traded as a risk-on asset, and the U.S. Treasury can print the difference. That's why it's risk-free. And also how deep and liquid the U.S. Treasury market at $25 trillion plus. That is why it is risk-free. So with only a going down from a 475 basis point premium that you can collect on the Bitcoin cash and carry trade in the futures market to just a 75 basis point premium, that's kind of no longer enticing. It's no longer attractive. And so now that the Bitcoin futures funding rate is hovering really close to the risk-free treasury rate, outflows are likely coming, these outflows that you see here are likely coming from the largest ETF holders like Millennium, Jane Street, and Point72, who've been using this cash and carry trade. Okay, and as the arbitrage is now less enticing since the premium has fallen, they are now divesting. And of course, you see that reflected in Bitcoin's price. So those are the ETFs. The other side of things is NVIDIA, which I actually do not have pulled up. So I'll pull it up right now. NVDA, US equity. And we'll go to a simple candlestick chart here. So obviously NVIDIA has been rip-roaring since the start of the year. It has had a great year, up from $46. Now this is obviously the price post 10-to-1 stock split, but it has gone up from $46 all the way up to 140. Okay, so huge price appreciation, but it fell 10% last week and officially declared a technical correction. Okay, when a stock falls 10%, it is officially in a technical correction. That's what happened to NVIDIA, and NVIDIA is the leader in the U.S. stock market, one of the highest beta risk assets. Bitcoin is also a high beta risk asset, and so lo and behold, these things get traded together. No doubt NVIDIA falling in the way that it did also had a negative impact on Bitcoin's price, given that those two are so tightly correlated with one another in the way that they trade. Now, moving on to traditional price study, let's take a look at the 80-day and 200-day moving averages. So it says Bitcoin is down 5%. It actually fell down about well over 5%, right? 10% intraday. So zooming out here, you could see in the pink is the 80-day moving average. In the yellow is the 200-day moving average. The 80-day moving average serves more of a bull market price floor. During Bitcoin's bull market, I'll zoom out to the last cycle so you could see this pink line, which I'm going to highlight and make a little bit bigger. If I can click it, I guess I won't, has served as a floor during Bitcoin bull markets. You'll notice once we cross underneath it materially, it's basically the end of the road for the bull market. Now, the 200-day moving average is a much more firm support level. Okay, this is a support level that if we do fall below 80-day, the 200-day kind of serves as a last resort price level for people to buy in, or the bull market is pretty much over. You see that we spend very little time underneath this when we do fall below, and bull markets end up continuing. We fell below it briefly last August before this move since October began in earnest. And you'll see that since we broke below the 80-day moving average, we've kind of been looking at the 200-day moving average to see how cleanly it would bounce off. And you'll see the low yesterday of 58,500 is within striking distance, within $1,000 of the 200-day moving average. And we wicked down and bounced above it, and now Bitcoin is moving higher on the day. Bitcoin opened up at 59,500, and it is now at 61,500. Okay, so we bounced pretty cleanly off of that, and we'll be looking for a continuation, but that is a positive signal. Our view here is that the bull market is not over, and we'll go through a couple more levels today to confirm that. But this technical analysis is very, very encouraging that Bitcoin did not move down and touch it. Rather, it approached it and bounced pretty cleanly off of the area around the 200-day moving average. Very encouraging. Shifting gears over to some on-chain data. This is the short-term holder cost basis. Now, you know that the short-term holder cost basis is the entry point for bull market Bitcoiners. People that enter the bull market, they only hold Bitcoin for a very short period of time, transact with it on-chain only a few times, and then they sell. They're in the market for price appreciation. Some of them become long-term holders. They mature as their coins age and they don't move anymore. They become long-term holders. But those short-term holders, right, anybody basically less than 1 year, these are the people who enter during bull markets. And so the short-term holder cost basis, in the same way that the 80-day moving average of the spot price is a floor for bull markets, the short-term holder cost basis is also a floor for bull markets. The short-term holder entry point, the average point at which these bull market Bitcoiners enter the market. You'll see that during the last bull market, it served as a floor. When we crossed underneath it, it basically meant that the bull market was over. And now it is serving as a floor once again. Unfortunately, price has recently dipped below the short-term holder cost basis. Since June 21st, since June 21st, the spot price has plunged below the cost basis of short-term holders. It's now about $3,000 underneath it. So if this structure persists, it has historically resulted in a deterioration of investor confidence. This is from the Glassnode Insights newsletter. And this risks a correction deeper and taking longer to recover from. Should we plunge beneath it and we don't kind of rocket around it like the Apollo 13 mission, kind of slingshot it around the moon? If we don't, kind of move below these levels briefly and then slingshot back up, it's going to take a longer time in order for momentum to build back up and us to go back above it. Here's a different chart that actually shows short-term holder capital flows. So in the blue, this is capital inflows when the cost basis of 1 week to 1 month holders trades below the 1 month to 3 month cost basis. So this underscores a positive momentum in demand. So the blue areas are where we see a positive momentum in demand from these short-term holders that drive a lot of the bull market Bitcoin price action and attracting new capital into the market. And in the purple is capital outflows. So the blue is capital inflows. The purple is capital outflows from short-term holders. When the cost basis of these short-term holders plunges, 1 week to 1 month holders plunges below the 1 month to 3 month cost basis, that structure signals a diminishing momentum on the demand side. So the blue side indicates fervent and rising demand, and the blue indicates a diminishing demand and a net capital outflow. Okay, so during previous bull markets, you will note that a negative capital flow structure has occurred up to 5 times. You'll see it marked during the 2016 to 2018 bull market that you could see there. This capital outflow structure from short-term holders happened 5 times. During the latest bull market, during the second to last bull market from 2020 to 2022, it also happened 5 times. And during this bull market, it has happened 4 times. Okay. So we can see that the structure has been in play since May and into early June. And so once again, this is an outflow period from short-term holders. And all else equal, should we be exhibiting the exact same structure that we did in the last 2 bull markets, we have another big period of capital inflows ahead of us and another period of capital outflows as well. And then following that, another period of capital inflows. Of course, we do not take on-chain as gospel. This is just another way of viewing Bitcoin through another lens, through the lens of buyer behavior. And at the end of the day, that's all markets are. Markets are a reflection of human behavior. And should we be taking this as a historical proxy for what to expect? Bitcoin is going through this consolidation phase. We'll see another period of capital inflows before we go ahead and consolidate again. And then, of course, see another period of short-term holder capital inflows. One other view for you guys is that long-term holders haven't realized the same amount of unrealized profit that is indicative of previous bull market tops. So this is net unrealized profit and loss. Basically, when this ratio rises into the blue here and stays there for an extended period of time, that's when a market top is forming. We have not entered the blue phase, which is marked as euphoria. We have entered the period that is marked as belief. And we have not entered the historical topping phase, right? So short-term holders come into the market, they kind of drive the price a whole lot. And then as long-term holders, coins appreciate and appreciate and appreciate, eventually it reaches a point where they begin selling. We have not historically reached that point of extreme valuation that drives long-term holders to sell and is a catalyst for a bear market. We haven't entered that yet, okay? So that's where we are on the on-chain side of things. At the end of the day, guys, Bitcoin is a macro asset, and macro tides kind of change capital flows at the margin. Bitcoin is the world's best proxy for global liquidity. We've seen that time and time again, and now Fed speakers are coming out, and they're talking about how the unemployment rate is set to rise. The labor market is set to soften after a very long period where it's been very resilient. Now we actually have Fed speakers coming out and saying, look, into the end of the year, we expect a little bit of softening in the labor market. And of course, what that means for Bitcoin, which moves out and ahead of these macro moves, of course, is going to underperform at the margin. But at the end of the day, guys, we encourage you to zoom out, okay? Bitcoin is all about adoption. That is the main story here. And through time, wallet addresses are rising. Whether you own a huge amount of Bitcoin or a very, very small amount of Bitcoin, the TBL thesis for Bitcoin is unchanged. It is the apex monetary tool. It represents absolute scarcity. And so while we're in a period of extended consolidation right now, which we just analyzed from a Bitcoin native, the Bitcoin native side of things with on-chain buyer behavior, as well as the market pricing side of things with basic market psychology, the long-term view for Bitcoin remains unchanged. In a world of monetary abundance where US dollars can't stop getting printed, where the United States fiscal situation is deteriorating and deteriorating rapidly, the United States Federal Reserve is forced to print the difference and monetize the US Treasury's increasing debt load, right? In order to maintain the same level of economic activity, we need ever increasing units of debt as the marginal productivity of that debt declines. And the buyer of last resort, the Federal Reserve, time and time again has shown you that the way it does that is by creating money out of thin air to monetize or purchase ever increasing amounts of the ever increasing US Treasury debt. The end game is certain, and so for Bitcoin as an asset, we believe it will eventually transition into the apex risk-off asset that it is. It represents the only known absolute scarcity in the universe, and so as the situation with not just United States fiat currency, but global fiat currency deteriorates, Bitcoin is a risk-on, high-beta asset that moves with stocks like NVIDIA right now, but eventually, we believe that in good weather and in bad weather, Bitcoin will perform its function as the apex risk-off asset that people go to in both good times and bad. So when in doubt, zoom out. If anything, you shouldn't be trading on very, very short time frames. I just wanted to give you some context about the moves around Bitcoin and where we're headed over the next several months. We view this as a period of healthy consolidation amid a rip-roaring bull market. Given that it's an election year, we do not view as over yet. So that's all for today's video. Thanks so much for sticking with me. I do appreciate it. And once again, a word from our sponsor, River. They are our Bitcoin exchange of choice. Invest in Bitcoin with confidence at river.com. They have multi-sig cold storage, so fully one-to-one reserve custody, no FTX stuff going on here. They hold all of your Bitcoin in-house in a proprietary cold storage solution. They also have zero fee dollar cost averaging. So in times like this, you're going to want to stack some sats. You can do it over at River. And they're fully licensed and regulated in the United States, and they have US-based phone support as well. They care about their customers. If you want to invest in Bitcoin, the only place to do that is over at River. Go to river.com/TBL to claim that special offer I mentioned earlier. Get up to $100 in Bitcoin when you make an account with them and purchase some Bitcoin. So that's all for today. Once again, thank you guys so much for watching. I do appreciate it. Make sure you subscribe and hit the bell notification icon so you'll be notified when we upload a new video. Keep it here, the Bitcoin Layer, for everything Bitcoin and global macro, and we'll talk to you guys very soon. Take it easy.